Okay, so it's 6:03. Let's start this session. Hi, everyone. Thanks for joining in today. We are doing this unique webinar where essentially we are trying to map out how investor at different stages of their life, how they can think about investing. And to do this, we are also doing it very uniquely, having three of my colleagues from Syfe join in to share their own investment journey with all of you. And me, Ritesh, who, as you know, head up investment and advisory, to kind of like look through how they have been doing in their investment journey so far, and possibly what could they do different as they move along. We will also make sure that we can broaden out these specific examples to a wider audience in terms of how you could think about your investment journey as well. So I hope this session is useful for anyone who is joining in today, what different life stages that you are in. Hopefully, this should give you a better perspective of how to manage some of your goals and aspirations financially as you move forward. There is a QR code if you look at the bottom right. Please scan this QR code. So as we are doing the session, if you have questions, just feel free to post those questions. And towards the end, we will dedicate some time to take some of the Q&A. If you're not able to take all the Q&A, we will make note of them and we'll come back subsequently on those queries too. So in terms of today's agenda, I'll do a brief introduction about Syfe. I'm sure most of you are already clients of Syfe, so you'll know pretty well what we are and how we manage clients' monies. But more importantly, we'll move into these specific subsections. These will be short and sweet, but hopefully it'll give you a very good perspective depending on which age bracket you are. How should you be looking at investing, whether you're in your 20s, 30s, or 40s and beyond. And as I shared earlier, we will then wrap it up with Q&A. So before we move forward, I'll do a quick introduction to Syfe. So Syfe is a digital investment platform. We are headquartered in Singapore. We have a CMS license to manage money for retail, accredited investors, and even institutions. Our goal is to provide the best tools and resources that so that people can improve their financial position and attain better outcomes in life, right? So we have been in the business for over 4.5 years now. And I'm proud to say that we are one of the only holistic all-in-one platform in Singapore. So when you want to invest, you don't need to go to 5 different places, whether you want to have a managed solution where you decide more or less what objective you want to achieve, and we curate a portfolio solution for you. On the other side, if you want to DIY and invest into single securities, you want to buy that Apple stock or a Tesla stock, we have a brokerage platform. And then more importantly, over the last couple of years, given how interest rates have moved so much high, a lot of cash instruments are becoming very, very popular. And on our platform, a lot of our investors have obviously taken advantage of these high interest rates to lock in those returns using our cash solutions, including our flexi as well as guaranteed solutions. In terms of the 3 pillars, as I said, we have the managed portfolios, we have brokerage through which you can DIY, and then we have our cash management solution. Overall, we manage money for over 100,000 investors in Singapore. This represents more than 5% of the adult population here, and essentially kind of like shows you the trust that everyone of you have placed in our ecosystem. And we continue to make progress and make things better as we move along to help you in your investment journey and to help you do better in your investment journey. So whether it is from a security standpoint, whether it is the expertise that we bring onto the table and giving you guidance in terms of your investment, or making sure that your cost of investing remains very, very low, we take care of all of these things for you. In terms of our investment journey, as I shared earlier, we are more than 4.5 years into the business, launched in 2019, and we've continuously innovated through our journey, whether it is the REITs portfolio that we launched early on, and it is the only kind that exists in Singapore, the most efficient way for you to build a diversified REIT strategy. We have expanded into multiple jurisdictions. We launched a few new strategies, whether it's the cash management solutions, the fixed income solution, which is called Income Plus, launched in partnership with PIMCO, as well as expansion into multiple markets like Australia and Hong Kong. So today, this is the more exciting part. We will go through the investment journey of three of my colleagues. The first person that I'll interview today is Abraham, or we fondly call him Abe. So Abe, if you can come online, are you there?
Hello. Good evening, everyone.
Hey Abe, how are you doing?
Good, good. Been a busy day today, but happy to be here.
Great. You've been with Syfe for how long?
Slightly more than 2 years actually. Yeah,
Wow.
been
It feels
yeah,
like forever. I mean, you're so much ingrained into our ecosystem. Any problem that I have with our product suite, Abe is usually the go-to person that I'll go and check in. And he's done an incredible job building a lot of like our infrastructure and our front ends and all as well. So Abe, thank you for joining in today. Slightly different topic that we are discussing compared to what you
yeah,
usually are subjected to from me.
yeah.
But very excited to have you. And let's start with a few basic questions, right? Like, obviously, as a young investor, I think you've started your investment journey very, very early. Will be great if you could tell me a little bit about, when did you kickstart your investment journey? And what kind of risk profile do you usually follow when it comes to investing?
Right, yeah. So I started investing when I was 18, so that's 10 years ago. My
Wow.
first
So at 18, you already started investing.
Yeah, but it wasn't into any high risk things. It's more of some REITs in the local market.
Mhm.
And then I started exploring a little more into the US market and stuff. And about 5 years ago, I started seriously looking at my retirement at a high level. And what I did since then was, to reflect on the lifestyle I wanted,
Mhm.
consistently measuring month on month, what are the potential cash flows that I go through and what I might need in the future. And that's where I arrived at, hey, I need to be aggressively investing and saving so that I can hit, a target number about 5 million.
Wow, 5 million. And I gather, like, in terms of that 5 billion target that you have, is that a long-term goal that you have in mind? Are there any other goals that you have as well?
Yeah, so recently thinking, maybe settling down, getting a house. I think the biggest financial commitment since my master's would actually be a house. And like HDB and property prices have been like going through the roof. So like that's one of my concerns actually.
Got it. So owning a house, goal number one. Goal number two is to, retire with 5 million, right? Like, 5 million is a pretty aggressive number. I think like, obviously, with the fact that you have started investing early and we will go through it, I don't think it is, not possible. I think it is definitely possible. And especially, I think looking at your, I guess like view, you are someone who is not looking to retire early. You actually want to work longer so that you can give your money even longer time to grow. And given that, like, if you are 28 right now, if you want to retire at 70, you have got like some 40 years to go, man.
Yeah, exactly. Like want to make use of time and compound my monies along the way.
Awesome.
So actually on that note, I want to kind of go into my investment journey so far
Yes.
and how I've been allocating my investments. Generally, it's focused on picking certain stocks that I felt are quality companies, and I usually only take a position when it comes to them having an attractive valuation. Occasionally, I do have like a small focus on the macro conditions of the market. Lots to unpack here, but I think basically, if I were to describe based on some fundamentals, if the PE is high for a given market, say the US, then I might look at some other geographies like Hong Kong, those sort of things. Yeah, not sure
Yeah,
what
yeah,
are
no, it
yeah,
is definitely helpful. Look, I think overall, what I understand is you have a much more like fundamental driven approach when it comes to investing into the market. You follow an aggressive strategy. You have a portfolio which is predominantly single security based. Is that
yeah,
correct to say? And
Yep.
I think like, when you're um, just looking at, this sharing that you've done with us as well, some of these stock picks that you're doing with a very robust analysis, etc., you intend to hold those for a very, very long period of time, right? Like, 30, 40, 50 years.
Exactly. Yep.
And you're looking at strong moats when it comes to investing into these securities. And then obviously you also have, other stocks that you are investing which are more of like, shorter term in terms of overall timeline, because you're investing with a more like a 10-year horizon to achieve a
Yep.
financial independent state. And there, I guess, like you're looking at hyper growth kind of companies, multi-baggers, I would say. Is that correct?
Exactly. So I would categorize it very quickly into two categories. The first group, as you mentioned, large caps, companies with consistent profit or revenue increases quarter on quarter, year on year, those kind of time horizons. They should have a large share position on their balance sheet, and they should have some strong moat or some sustained competitive advantage. The other group that you mentioned, which is in a shorter time frame, and I shared on the slide, generally I take these positions inspired by hype cycles and market momentum.
Mm.
And if the company can prove some consistent revenue growth, that's a plus. So that's generally how I take positions when it comes to stocks.
Cool. One last question. In terms of actual returns, like obviously you've been invested for the last 10 years, right? How have you done? Like, obviously market, if you look at the markets themselves, the broad-based, um, S&P 500, for example, has given more than 10% annualized returns over the last, 10 plus years. Um, so compared to that, like how do you see your own investments? How have they panned out? And is there something that you are looking in terms of reassessing?
Yeah, so I actually did a review this morning. I'm proud to share that my large cap portfolio is now delivering 9% return, at least in the last year to date, right?
But what
And
about long
my
term? Like
long
that's a
term,
year to date.
yeah, long term is actually negative, I would say, like due to the market turning in the past 2 years. But I do see some potential growth in how I've reallocated my stock holdings.
Got it. So if I were to roughly map out how you've allocated your investments, this is how your pie chart looks like, right? You've predominantly invested into stocks, and these are single security stocks. You do
Yep.
have some ETFs, equity ETFs, but I will assume even these are thematic ETFs or very sector specific ETFs, or are these like broad-based ETFs?
I would say they are broad-based ETFs.
Okay.
Generally, there's some exposure to certain markets, such as, okay, maybe I won't go into the details, but
Hmm.
emerging markets and developed markets.
Okay, got it. And then obviously you have these smaller allocations that you're slowly building up more from a diversification angle, I would suppose. And there is some bond ETFs that you have taken as well. But predominantly, what I can see is your portfolio is dominated by these single securities. And if I go back to the previous slide, it is made up of a very concentrated, selection of stocks on the large cap side, which is 7 stocks, and on the other side, which is 15 stocks. Typically what happens is, look, I mean, from a short term standpoint, you might see spikes in terms of returns and you can feel really good about it. But if you are not having enough time, and with a day job that you have as well with Syfe, you might not have enough time to dedicate and look at these stocks on a continual basis and manage them efficiently. And that is what tends to happen over a longer duration. You don't know how to size them. You don't know how to, what point of time you should add, remove, etc. Especially on the second part of it. I think the first part you want to hold them for eternity. These are like long-term mode kind of companies, so you want to hold them. But the fact that you're so concentrated on stocks, it exposes you to very specific risks of these individual companies. So my recommendation to you will be to look and diversify a bit. And what that could mean is reduce your allocation to single securities and add more towards broad-based, market, which will help you form a very, very stable core, right? And at your age,
Mm.
I think even if you are investing in a broad-based manner, you will see that the consistency of returns is much more important than trying to time the market and time the securities and trying to find that next multi-bagger of sorts, right? Because again, with the time constraint that you have, and this is not your day job, you will always be, one step behind, no matter how much, extra effort that you will put in and all. So I would recommend, yes, still have those single securities. I'm not saying take it all out, but maybe that allocation is a little too much into single stocks. So if you look at this new pie chart, the recommendation is like to move some of your allocation from stocks into broad-based ETFs, and you could consider a globally diversified portfolio like the Syfe Equity 100 as well, because that way is what happens is we keep it optimized for you. You get the global diversification. You don't really necessarily need to take these individual positions into emerging market, developed market, and the US. We kind of like take care of it on your behalf. And on top of that, if you still have views, implement those views maybe through the equity ETFs. You can use the brokerage platform. There is the stocks, if there are individual stocks that you really, really like from that long-term perspective. So I don't think that you should stop doing your stock allocations. And some of these companies which you really believe in very long-term modes, you can keep them, but definitely diversify into these broader allocations as well. I think they will help you form a bigger anchor, and you'll be less subjected to the fluctuations in the market, and especially over the 2022 odd period. If you are very concentrated on very specific stocks, there were some people who were
Yeah.
so growth oriented that you can lose 30-40% very, very easily, right?
Yep. That
So
happened to me.
exactly. So again, I think only two things for you. One, I guess like reduce allocation to single securities and diversify into these broader aspects. The other goal that you had, which is the buying of house, I think the fact that you already have these bond ETFs and you have the income and cash sort of allocations, I think those are the more conservative allocations, which should help you in the near term cash needs, and your allocations are much more conservative. But if you have that longer term horizon of 30-40 years, then having a predominantly equity portfolio still positions you very, very well.
All right. Thanks for that, Dash. Loads of
Cool.
food for
So I
thought there.
just thanks, Abe. I think like, again, doing a great job, but just trying to broaden it out to other folks who are today joining us as well. When you're in your 20s, essentially you're looking at few things, right? You're entering into the workforce. You are becoming much more independent, right? Like, you're no longer dependent on pocket money. You are earning yourself. And that basically means that you're responsible for your own finances. And what that translates into is every month there is some budgeting that you need to do, right? You're starting to make money, but you should also start to save money, right? And the great thing about being in your 20s is you have very, very less financial obligations. So, Abe, you're not married. You potentially are not yet living into, like a rental apartment of sorts. So you can save almost, 60, 70, or even 80% of your income. And that's a great state to be in, right? Like, I'm sure you earn and, and save a lot more
Yeah,
compared to,
exactly. That's what exactly I'm doing.
Awesome, awesome. So, in terms of like managing your finances and having or building more better personal finance habits, I think the rule of the thumb is that if you're thinking of monthly budgeting, you should at least try to save 20%. But I think people who are in 20s, you can actually flip it this whole thing around, because your needs and your especially I think the needs section is not 50%, it might be actually 20%, and that basically means that your savings could be 50% or even more. So I would actually recommend save more if you can during this period, and just not just save, start investing early, right? Do keep some of your emergency funds. I think that's very, very important, so 6 to 12 months. But beyond that, I think you should not have too much cash as well. The power of compounding is with you, right? Like, age is by your side. If you are someone who is in the 20s, this is actually a great time for you to just put, even if you're saving $500 or $1,000 a month, if you compound that over the course of 30 years, 40 years, etc., you just see this particular example where if you start at 25 and you only invest 600 odd dollars here, if it grows at an 8% per annum return, you're already making $1 million by the age of 55. And I'm sure, Abe, you are able to contribute much more. So if you have higher contribution, plus the fact that you don't actually want to retire by 55, you want to retire by 70, actually your goal of 5 million is very, very reachable. right? And I think
Sure.
the important part is also the fact that if you delay your investment journey, you will need much, much more later on. So start investing early rather than waiting. Cool. And yeah, like you have the capacity to take more risk. But the only thing that I would recommend is have a very, very strong core using broad-based ETFs and portfolios as anchor.
Oh,
Does that
thanks for
make
this
sense,
insight,
Abe?
Ritesh. Yeah, perfect.
Awesome. Thanks, Abe. I think we are running a bit slow, so I'll try to fast track a bit. I'll move over to Sheryl. Hi, Sheryl. How are you doing?
Hi, Ritesh. Evening, everybody. I'm good.
Thanks, Sheryl, for joining us today. And Sheryl is our incredible client service lead. I'm sure if you have reached out to us for different queries on our, services, Sheryl will be a voice that you will hear very, very often. And she is, a superwoman. Like, she has done so many things, so many great things within Syfe. But more recently, you also had a kid just 1.5 years back. Sheryl, is that correct?
Yeah, yeah, yeah. So
Awesome.
I have a baby that is 1.5 years old.
And how has that changed your life? Is that, something that has changed your perspective with respect to how you manage your finances?
I would say it does. It definitely does. So previously before I have a kid, it's more of like targeting purchasing our on like getting married, purchasing our new house, as well as like purchasing a car. And then after having a kid, is really more focusing on kids' education as well as on retirement as well.
Yeah, and given that you have a kid, do you also plan, more safety nets in terms of like insurance, etc., as well, or is that something that you've not yet looked at?
Yes, definitely. We cover the health insurance for the family and the kid. We also purchase like investment linked policy as well and endowments, more for like a forced savings for the future of our kids' education, as well as for retirement as well.
Great. And in terms of your investment journey, I definitely know that you started investing after you joined Syfe. So good job there to kickstart your investment journey. But I also understand that you've been a lot more conservative when it comes to investments in general. Would you be able to share how you've been investing so far and why?
All right. So how me and my husband manage our finance and we invest is we look at it as a whole. So me and my husband manage our family finance together. He's more of a higher risk person, so he does more of the higher risk investment like crypto and maybe on equities. Whereas for me, I'm more of the risk adverse. I would say person that I'm not really a very risky person, so I actually invest more in cash plus guaranteed something that's more stable. I do have a little bit portfolio in like REITs, income, a mixture, but a higher percentage is on cash plus guaranteed.
Great. And I do see that, like, you've also started doing a little bit of dollar cost averaging into, funds and ETFs as well, which previously you were, a lot more skeptical about.
Yeah, so I was previously a little bit more skeptical because I would say the portfolios that I used to have that I started investing in Syfe about 3 to 4 years back when I just started isn't actually performing very well. So that's why I was thought of looking at something that is more stable, something that is more of I would say capital guaranteed because ultimately after having a kid the focus will be on a kid, right? Where I would say I tend to be a little bit more cautious on like my investments as well as where I put my funds in. So that's why I was looking at more of like something that is more capital guaranteed as well as return guaranteed. So that's why when cash plus guarantee came about, I kind of moved most of my investments over to guaranteed.
Yeah, I think that's a great sharing that you've done. I think what happens is typically, the first your first foray into investing, if you just start investing and if you don't get the returns, you kind of like lose confidence a bit, right? Like, and unfortunately what has happened is over the last 3 years, if you started investing somewhere in 2021, 22, the unfortunate thing that happened was you started pretty much at the peak of the market. And what that meant was basically you saw the downturns more prominently than the upside of the market. And it's only now that the market has recovered, that if you did start investing back in 2021, 22, you will see some of your returns coming back and being in the positive territory. So yes, I mean, it can be daunting when it comes to investing. If you obviously look at a specific periods of time, either you can have a great journey depending on when you entered, or you could have a journey where you keep losing confidence. And I think the great thing about the current setup is obviously there are different solutions available on the platform where you can park your money when you are not sure and you're skeptical about where the markets are. But broadly speaking, I think on a longer term basis, I would actually recommend you not to be afraid of the market, right? This is the 2 year window that you're looking. And that window to couple years, actually the returns in the equity markets will be much, much, much higher than keeping money in cash. So if you just look at your current allocation, what you will see is predominantly your money is invested in cash. I mean, like actually not invested. And that might feel good because the cash is actually earning you, if you're putting in the guaranteed product 3.75%, which is not bad, right? Again, it's pretty good in Singapore dollar terms. But the reality is, if you look at just the last 1.5 years, the market is up more than 40%. So you've definitely trailed the market compared to your cash investments. And while it is incredibly tough to time the market, on a more longer term basis, you definitely should move a little bit more towards equity oriented investing, because at the end of the day, you have two main goals, right? One is financial independence and your child's education. And both of these are long-term goals, right? Like, if you think about financial independence, it is potentially, again, 20 plus years. If you think about your child's education, it is 10 to 15 years down the line. So both of these are fairly long-term. And even though the equity markets, you might argue that it is at all-time high and there is potential, volatility that can come in the near term and all, this is something that what you should be aiming towards. You don't necessarily need to get to this state right now. You can tranche your investments in, but from a longer term perspective, don't be afraid of the equity market. Compared to any other asset class in the public domain, equity markets and equity strategies are things that will give you, the highest return for the risk that you're taking, right? Obviously, in the short term, there could be volatility. So when you're coming into the equity, moving so much cash at one go from, your cash savings to equity, again, can be quite daunting. So I don't recommend you move all the way at one go, but you can slowly start dipping in. Like start with your DCA. I think you're already starting to use DCA approach. You're investing into certain equity ETFs. And from an automation standpoint, and if you don't have the time or you don't have the requisite expertise in terms of choosing the right ETFs, again, our core equity 100 is a great place to kickstart that journey as well, right? So yeah, number one, decrease your allocation to cash and look at increased allocation to the equity market. If you're afraid to go in all in one, look for a dollar cost averaging based approach. But equity markets is where you will, get your long-term growth for your goals that you have mapped out. So again, trying to broaden it out a bit more, right? Like, when you are in your 30s, what are the key things that you're looking to do? You're trying to advance in your career. You are getting more earnings in place, right? Like, you are progressing in your organization, you're making more money, your savings are higher, but at the same time, you have more dependencies, right? Like, compared to Abe, who had no dependents and he's a free bird, the obligations that he has is very, very limited versus Sheryl, you will have to think about your family, right? You are thinking about your child. You've, your insurance policies now. I mean, there is a question mark on insurance investment linked policies. I mean, again, we recommend having term insurance in place and then investing the rest rather than ILPs, because we all know ILPs do suffer a lot of fee leakage. So that's something that you could also think about as you move forward. But broadly speaking, yes, you should definitely look to insure. You're looking to buy a house, these are, or you're looking to upgrade your house, right? Like, these are some of the key things that people are looking to achieve while they are in their 30s. So yes, insurance planning is important. Investing as a family, budgeting as a family, aligning on your goals and priorities become very, very key. And you need to be more strategic with your goals, right? It is no longer that, this is a great kind of like product. It is giving X% of return. That's why I'm investing. It needs to move from product specific approach to what are the goals that I'm trying to, solve for? What is my risk capacity? What are the suitable investment portfolios that can meet these goals? That's what are the questions that you should be looking to get answered. And then you should be taking, these specific action points and then have a disciplined strategy to contribute towards that goal. Right. And one quick way to think about these goals could be, thinking of it from a duration of investment and the risk that you're willing to take. And typically what happens is the longer the duration of your goal, the more aggressive that you can get, right? So typically if you are investing for a 10-year plus kind of horizon, you can actually go very, very equity heavy compared to your shorter term goals where you need to do a more balanced approach per se, right? And that's why for your case, Sheryl, getting into more broad-based ETFs, etc., could be an interesting way to get more comfortable with the growth-oriented investment markets. And again, given that if you don't have the requisite expertise, there are these curated portfolios like Equity 100 that you can look at as well.
All right, thank you, Ritesh.
Awesome, Sheryl. I'll move over to Willy next. Willy, how are you doing?
Oh, hi everyone. I'm good. Thanks, Ritesh.
Thanks, Willy, for joining in today. So Willy obviously is our ops manager. Again, all the processing that you see of your funds on a daily basis, if it is not Willy, those things will not get done. So thanks a lot, Willy, for making our systems super robust and making sure our clients keep getting great experiences when it comes to money management.
My pleasure.
Thanks. Willy, why don't you share a little bit about your investment journey? What state of life are you in right now? So you are 41 and you're married, but compared to Sheryl and Abe, you have a little bit different priority in terms of how you're managing your finances.
Yeah, I think maybe I speak for a group of people like myself, at least of my peers. We tend to marry a bit later. So I've actually got married only last year. And so I think in my earlier years, I've done a little bit, I've spent more time on myself, buy more things for myself. And I tend to, take more risks. So in terms of investment journeys, when I was younger, I've actually had different experiences like trading. So I think I started investing at age 25, where I've had my forays of things like margin trading, intraday trading,
Wow.
contra trading, right? So I've had my fair share of a little bit of those experiences, and
how did that go though? Did you make a lot of money there?
Yeah, so that's a good point, right? So eventually, where I am now speaks volume of what has happened back then. So now I'm actually more towards long-term investing and investing with a understanding of what I'm buying into. So actually back then, when I realized that I was doing a lot of speculation and stuff like that, it wasn't. I think for one, it was high risk, and I get very drawn into it. So my day gets very drawn away from my work because I spend a lot of time thinking about those things, right? So it's one of these that put me away. And secondly, when you have a very narrow and very short-term investment time frame, you tend to take a little bit more risk and you tend to make very hasty decisions. So I actually honestly had lost some money back then. And I think this is a learning journey on my own, which I learned along the way that, some things that I really need to know before I invest. So along the way, I've actually learned to pick up and understanding the companies that I buy into, and to also buy into companies like what Abe said, to have certain kind of competitive advantage, a moat, and where they are constantly making money. So I'm also looking at those. So I tend to be now more selective in terms of buying stocks. And I predominantly do buy into stocks. And I started off quite earlier on into REITs because I do like the Singapore REITs because of the dividend growing nature. And that's really where I started most of my investments and my long-term holdings back then. And then gradually into big cap companies and over time I'm trying to just grow my stock portfolio so that I can look at capital appreciation in time to come, and I'm also hoping to grow my income dividend in terms of regular income from REITs or even like fixed income products. And I think what has really been a little bit different in the past 2 years is my main focus towards cash, right? Because I think in the past decade, interest rate was always low. So cash was always to spend or to invest. right? But I think in the recent 2 years, because of the increasing interest rates, I've actually had a larger percentage of my portfolio in cash management products, right? So I place them now in like higher interest rate saving accounts, and I also put quite some amounts in treasury bills. So I think treasury bills is one of the very common instruments that I think most Singaporeans in recent times are very heavily into, including myself, because of the high yield environment. So I do place them quite an amount, I think last year onwards. And I do actually see that the cash plus guaranteed product that we have here is really, really helping me, because some instances on why I actually switch over from treasury bills is, I think for one, treasury bills is only fixed at a 6 months tenor, right?
Yeah.
So you only can choose to do 6 months or not. And secondly, you do not know what is your interest rate return until the day is placed, right? So that's two.
Correct.
And the other thing that is also a nuance is you only get a certain amount of funds that you put inside to be placed because of the balloting system, right?
Yeah.
So it's very annoying, because you say you want to put X amount, and at the end you only get to place like a certain percentage of it, and then next month, yes, exactly, you keep pushing and trying again. So that's very annoying. And the last thing that kind of irks me a little bit is, because of the nature of it being placed, it's only subscribed like a fixed date in the month, right? So there's a lot of opportunity costs.
Yeah.
So I thought, when I saw Cash Plus Guaranteed in the Syfe product suite, I thought it was a pretty good product. And because it actually solves all four of these issues that I have, it's multiple tenors. I know what's the rates that I'm investing into. Every dollar that I place is definitely going to be invested into the amount that I want to. And I think it's very flexible in terms of how I manage my tenors. I choose to do some in the 3 months and 6 months in the earlier times when I think the interest rate was going up. And then now, when I feel like the interest rates are doing a topish, and I mean Fed going to taper off with interest, I'm gradually putting them in the 6 to 12 months. And I'm even thinking like switching them out gradually more into fixed income portfolios, or even dividend portfolios.
I was just gonna say that, right?
Yep.
Really, and I guess that's kind of like goes back to the goals that you have in mind as well, right? If I see here, obviously getting into your 40s, you become a little more serious about, retirement, right? And being debt free. So this becomes even more kind of like important once you enter into that phase. Obviously, for you've got no kids, but still, family planning means that you might consider it as you move forward, which basically means that you are looking at alternative sources of income as well, and any other aspects that can help you simplify your lifestyle as well, right? So when it comes to, just looking at all your journey so far, and it's great to actually hear the fact that when you are young, you want to try out different things, and it's kind of like the wild west, right? You dabble into multiple different investment opportunities, and I think it is still healthy, right? Abe, what you're doing right now, Willy was doing, probably 10, 15 years back. And yes, I mean, you can dabble into some of these. What I would only recommend is, don't put a substantial amount, right? Play, if you do want to play with some small allocations, and use that as a learning opportunity, right? But have a very, very stable and long-term core allocation. I think it is important that you anchor with long-term diversified kind of portfolio strategies. And then if you want to have a 10, 20%, or if you're super aggressive, 20%, 30% kind of allocation to these, very specific instruments, and you want to do something wacky, in terms of derivatives, or if you want to invest into crypto, these are all, okay. But what you should not do is derail your long-term plans because you have allocated a substantial portion of your money into these while you've not really formed that anchor in the first place and all. So I think, Willy, if you look at your portfolio right now, obviously, even in the current state, you're very, very cash heavy. And again, if I go back to the example that I had shared with Sheryl as well, while cash has given you pretty good return, 4-5% over the last 1.5 years, the reality is it has trailed the returns of the equity markets, right? And there the returns are north of 40-50% if you consider just 1.5 years of returns. Obviously, everyone was burned in 2022. So that backdrop has made people very, very hesitant coming into the equity markets as we, move along. But if again you zoom out and look at, very, very long term, that's where you will get your growth per se. Now coming into your specific needs, if you're planning to have kids, if you want to have a more income-oriented strategy defined as well, I think moving from cash to bonds could be a pretty good way to look at that. And I think bond investing could be very interesting. And this is something that I shared more recently in the Business Time articles that came out as well, where essentially bonds is one asset class which is poised to benefit in two ways as we look 1 year, 2 year, 5 year down the line, because interest rates are at the peak. While I think the Federal Reserve has indicated that it is going to remain higher for longer, and we've now pared down the number of rate cuts to be maybe 1 or 2 this year compared to four to six earlier in the year as well. The fact is that there is very less likelihood of interest rates going up from this point of time. It might remain high for an extended period, but the likelihood of it going further high is very, very limited, which basically means really, really good for bond-oriented investments, because with bonds, you kind of lock in this high yield through coupons. And then eventually when the interest rates do fall, there is an inverse relationship with the bond prices and the interest rate. So if interest rates fall, the bond prices will move up. So you get the double benefit of capital appreciation as well as the high yields of the bonds themselves. And compared to the equity market investments, it's actually half the risk. So you're getting kind of like equity returns, but at half the risk of equity. So it's a great time to look at income plus. And just to flip it around as well, I think you are, in my opinion, a little too exposed to REITs as a strategy. I think REITs as an asset class is great, but it should be used as a satellite to your income. Broad-based bond allocation, you should allocate them partly to REITs as well, because obviously, again, REITs is no different than taking very specific sector bets, right? And the REIT portfolio, while over the last 3 years has struggled mainly because of these interest rate, aspects, as well as initially during the COVID pandemic, the demand hit that took place and all as well. So there is idiosyncratic risk when it comes to specific. So having a diversified income plus portfolio and then pairing it with REITs, I think is a great combination for you to generate that passive income in a more, smoother manner. And if you just think about like what could be the dollar amounts, right? Like, together REIT plus and income plus, the average dividend yield could be close to 6%. So if you, grow your income portfolio overall, the fixed income portfolio overall to around $200,000, then at a 6% dividend yield, that translates into $12,000 on a yearly basis or $1,000 a month per se. So that's a great way to think about, how much you could allocate to your income bucket and how you can combine the REITs portfolio and income portfolio to be able to generate that income in a much more strategic manner and for the long term. And at the same time, for your financial independence and retirement, you do still have, your core equity 100 portfolios, your equity ETFs, your single securities. So keep doing that. Like, if you are using the Syfe brokerage account, for example, you can keep buying some of these very strong, moat companies. Obviously, you'll need to do more research. I would assume that as you move closer to your retirement, your allocation to this, single securities will keep on going down, right? So compared to Abe, who was like close to 60% into single stocks, you're already at 10%. And that's similar to me as well. I mean, I'm also in my 40s now, and my allocation to single securities is also going down the more, closer I approach to the 50s and 60s as well. So just broadening it out for other folks as well. When you are in your 40s, you are reaching peak earnings, right? This is the best time in your life when it comes to, progress that you have made in your organization. You have, shown expertise, and because of that, you're now at potentially like, managerial positions or leadership positions. But at the same time, you've become more conservative. You're now much more focused to plan for your retirement, as well as you're looking to diversify. You're not, willing to take very, very concentrated bets. You're looking to get more consistent returns rather than very, very, magnified returns from that perspective. So Some of the key tips that I would share in this is review your goal in more concrete manner, right? Like, similar to Abe, who did have a concrete number, Willy, you should also think of a concrete number. And this is a rule of thumb, right? Like, this 4% rule is a great way to think. It is a starting point, I think. It is not the actual number, but essentially whatever your annual expenses that you envisage during your retirement, you should multiply that by 25. And that is the corpus that you need to get to, which if you do get to that number, essentially, if you spend 4% of that corpus every year, it will last you for 30 years. That's what the 4% rule, entails. So it's an easy, tool for you to get a rough gauge of at least, a dollar number that you can plan for. But obviously, there are more nuances to it. So don't just depend on it, but use it as a rule of thumb to get a ballpark number in place, and then you move from there. You're looking to have more tax advantage instruments, right? Whether it is CPF top-ups, whether it is SRS, these are instruments that can help you in optimizing your taxes. And then you're looking to balance your portfolio compared to how you have been investing so far. And income, etc., is also becoming much more important. You are trying to diversify your income sources, and that could include not just bonds and real estate as well, right? Cool. I think that covers the three cases that we have today. Thanks, Abe, Sheryl, and Willy for sharing all your experiences. I'll just quickly share some basics before we open it to Q&A. I think we're already at 6:50. So quickly, keeping it to basics, every one of us have three basic needs, right? We are either trying to optimize our savings, or we are trying to generate passive income, or we are trying to achieve capital growth. And as you can see, of the three guests that we have, like Abe is predominantly in the capital growth camp. Like, he wants to maximize his returns, and he's got a very, very long-term time horizon. Sheryl, on the other side, is, super conservative. She's on the savings bucket. And actually, you need to, now think about allocating more towards, capital growth and income to a certain extent. But Willy, I think you've been invested, and you have across the board investing in each of these three buckets. But at this juncture, still, you've been super cash heavy, given your experience with the investment landscape that has panned out over the last few years. But given where you are in the stage of your life, income becomes a more important aspect as well. And you should look to balance between income and growth at the same time. And in terms of how you can use Syfe to potentially do some of these allocations, we have the full suite of products. So whether it is the savings product from the cash management solution standpoint, whether it is the income solutions, so if you're trying to generate income, both income plus as well as REIT plus, you have growth-oriented solution. The core portfolios is the place where you use them to form your core. And then if you do want to take specific views on the market, you can do so through our thematic portfolios or use our brokerage platform as well to express your views into single securities and broad-based other ETFs as well. With that, I'll now open it up to Q&A. I'm sure there are questions. Before that, I'll also showcase this promo code. So if you're new to Syfe, please feel free to use this promo code. And there is a sweet starter cashbacks and cash credits that you can utilize to kickstart your investment journey. All right, so let's look at some of the questions. All right, so my colleague has shared this. Okay, so you mentioned many times, how should we think about the risk of de-dollarization of US bonds? All right, when is SRS and CPF investment coming? Okay, that's question number 2. Difference between income plus and equity 100. Happy to take that. And then goal-based investing, planning to buy a house in the next 3 to 5 years, but I also want to save for my retirement. However, I'm already stretching myself. Shall I focus on housing first? Okay, that is a great question as well. So let's take them one by one. I think the first question, which is talking a little bit more of this question mark that has started to come in with respect to de-dollarization, and I think question mark also on
whether US dollar will remain, the reserve currency. So I think, see, my take on this is, look, whilst some of these have, started happening, the capital markets are just too deep with US dollar. And what that means is it will take, a decade or a few decades for any of this de-dollarization to materialize. So you are not moving away from US dollar bonds or US dollar investments anytime soon. And that will continue to be the dominant form of investing for years to come. Yes, there could be aspects of dollar itself, in terms of the FX impact. The dollar might get impacted if interest rates start to come off. Then the dollar might depreciate against some of the other stronger currencies, especially like against Sing dollar, etc., and all. But again, from a total return standpoint, if you're looking just inward in the Singapore market, there are very few opportunities from a growth standpoint in the Singapore market. It is a predominantly mature market with companies that are much more stable and predictable kind of like revenue streams. But there is not too much growth. Means that like when you're looking at the Singapore market, there is mostly, I would say, dominated with dividend-oriented investments. So when you're looking to grow your money, you should definitely still look at a more global basis. And that basically means that you definitely need to look at US dollar denominated assets as a whole. SRS CPF, happy to share with everyone. We will soon have very good news in both these fronts. So stay tuned. Don't have a concrete answer as to when exactly, but this is something that you can look forward to within this year. Yeah. Number 3, difference between Income Plus and Equity 100. Actually, they're very, very different strategies. Yeah. So Income Plus really focuses on bond investing. Globally diversified bonds is what you're investing into through our Income Plus portfolio. And the objective of this portfolio is to generate regular income, right? And the nature of the asset class, which is the bonds that you're investing in, is fundamentally different than what Core Equity 100 invests, which invests into equity ETFs, which underneath holds stocks, right? So Income Plus invests into bonds, Equity 100 invests into stocks. Bond investing basically means that you are investing into a company and you are, basically, these companies are borrowing money from you. And in exchange for borrowing that money from you, they're giving you some interest, right? And that's the dividend that you are getting, or the, payout that you're getting from it. And eventually, when the bonds mature, then they're supposed to return back that money to you, right? Like, so they act in that manner from an income perspective. Versus in stocks, you're taking a view on the growth of the stock, right? Like, the stocks, you're taking ownership into the stock that you're investing into. And because you're taking ownership, if the stock grows in value, then you also participate and grow alongside, right? So that's what like the Equity 100 achieves on your behalf. If you go down, can we scroll down, please? Yes. Current interest rate environment, dismal performance of REITs. Shall I liquidate my REIT investments and put the funds into fixed deposits? I think it goes back to allocation, right? I think overall, I don't think REITs is a bad place to invest. But yes, over the last 3 years, it's been very challenging for people who have been investing only in REITs, right? So I would highly encourage that if you have been investing only in REITs, you should diversify it into income and other broad-based strategies. Overall, I would say I have a positive view on REITs if you look at it from a next 12 months to 24 months standpoint, because number one, yes, they have had a very, very tough time, but for obvious reasons as well. The interest rates being so high and the clarity on when interest rates will go down is not clear. So that those two things together have kept REITs in a very challenged kind of situation. But at the same time, their valuations are very, very attractive. Like they're almost like trading at 0.8 or even lower of price to book value, etc. And also that's really, really low from a standpoint of valuation. But that trend will not change unless we get more clarity in terms of interest rate movement and all. So I would highly recommend that broaden out your investments from a dividend standpoint into income-oriented strategies such as Syfe Income Plus, and use REITs as a satellite to that to sort of get that specific element as well. And from a bounce back standpoint, I do think that REITs should have a positive future as we, move into 2024 and 25. Did I miss any question? If you can scroll down, I think there was one more question at the bottom. Goal-based investing, buying a house versus, retirement. I think this is a great question. Look, I think at the stage that you are in, if you're already stretching yourself, I can imagine that you can only solve for one of the two goals. And if I were you, yes, I would also prioritize the housing first, because that's a more immediate goal that you do need to take care of. What I would do is as you reach closer to your housing goal, and through, if you're, time horizon is 3 to 5 years, I'm also assuming that you will grow your income alongside this, and that extra income can then go towards some investment into the retirement strategy as well. So I would say maybe, have a very small allocation to retirement at this juncture, have a predominant allocation to your housing goal first. And as soon as you reach close to that housing goal, you can flip again and, focus a lot more on retirement. All right, I think there might be more questions, and again, feel free to reach out to us on our different channels. We have our advisors at your disposal. There is advisory@syfe.com that you can email us as well. But I hope this session was useful to all. And if there is any last sharings that Willy, Sheryl, and Abe that you guys want to share, I will just give you maybe 30 seconds each before we close it off.
Don't have a sharing, but I see an interesting question. How do
all
I
right.
invest in AI through Syfe?
Oh,
Want to share the thoughts? Yeah.
Look, we are looking at this space very, very closely now. Obviously, putting something together in the current environment, we could, but we are very conscious of not putting something in front of you which can have a very it just doesn't become a fad of sorts, right? It's a pretty I think nascent area at this juncture. We are spending a lot of time and research to analyze how we should create portfolios that have artificial intelligence kind of embedded into it. But I think what you will see more from Syfe as you move forward is you will see a lot of AI elements from a standpoint of giving you insights about the market, right? Like giving you an understanding as to how you are currently investing into the market. How are you, concentrated or not concentrated? Are there areas and news that you care about more and you would want to learn about more and you want to keep updated about more? These are areas that will spend a lot more time in the near term, because, at many times what happens is you need quick answers, right? You're suddenly looking at something and you want to talk to someone to just get some sanity in terms of if you're thinking in the right direction or not. So these are areas which are, I think, much more, easier, not easier, I would say, but areas which I think are much more useful for the end investors to at least rationalize some of their thoughts to begin with. So this is where we will kickstart our journey. AI, with respect to actual AI strategies, this is something that we will keep putting a lot more, focus on as we move along. But this is still very nascent, and I think it will take a little longer for us to come back on that front.
All right, thanks, Ritesh.
Sheryl and Willy, any last words from you guys?
I think for me, maybe just a little sharing about since I'm in operations and a lot of my work is very SOP driven, I would think about investment in my coming journey as if I do have a kind of strategy that has been proven and it works, and an SOP that I can follow, I think it's better than having to go out and try it out on my own and make the losses and make the mistakes. Sometimes it's good in that way, but if I can avoid that through learning through mistakes and have a certain kind of a path that has proven to work, I think I would have chosen that to do so in my earlier days.
Awesome. Sheryl?
I think for me is I think like shared earlier, I started my investment journey only after I joined Syfe. So I think through my years, close to 4 years in Syfe, Syfe has actually launched a lot of different products which I think I've also explored into. And I think it's also a good exposure for people that are like myself, especially managed portfolios that are lazy investors and doesn't really like to monitor the market. The managed portfolio definitely do works. And I think what Ritesh has recommended on me shifting my funds into cash to actually equity 100 is something definitely I think it kind of works for me because equity 100 is fully managed. And it's something that I would say I don't have to monitor on a day-to-day basis after having to work full-time and then having a kid. It's something definitely I would say it's a very good portfolio for us.
Awesome. Thanks a lot, all of you, for sharing your investment journey with us today. I hope everyone who has joined today, there are some takeaways. We will have this session recorded and shared later on as well. So stay tuned if you missed out on certain sections. We will have this available in a recorded format, so you can again go through, and if there are specific use cases that you would want us to address more personally to yourself, then just reach out to the advisory team and we will be happy to help. Thanks, everyone. Have a lovely evening. Bye.